Wealthy and Wise is your guide to value investing, powered by Team Invest.
Hello and welcome to Wealthy and Wise. Well, markets are meant to reflect fundamentals, but what if prices are increasingly being driven by something else? From the rise of passive investing to the growing influence of AI and algorithmic trading, the way markets behave is changing. So what is really setting prices today, and what does that mean for investors? Well, today on Wealthy and Wise, we unpack how these structural shifts are reshaping markets and where the opportunities might lie. We'll also answer a viewer question, but first, let's add some value. Well, passive flows, superannuation and algorithmic trading are now a dominant force in markets. But if more money is following rules rather than analysing fundamentals, what does that mean for price discovery? In this segment, we break down what's really driving volatility and whether markets are becoming less efficient as a result. And joining me today is Andrew Coleman from Team Invest and also Mark LaMonica from Morningstar. Great to have you both with me today, gentlemen. Well, let's start then with you, I guess, Andrew. Passive investing, do you see it as an evolution or a distortion?
Well, I think it's both. So, really, probably it's worth starting in the beginning. Passive investing is just simply defined as investing by mimicking a published index. So rather than trying to pick individual winners or losers, you're trying to follow a general theme, whether that's the market as a whole, say the ASX 200, or a commodity theme, or an IT theme, or a real estate theme. And it's important to note that it's a relatively new thing. Index investing really only started in the 1970s, really, with Jack Bogle. But today represents more than half the money involved in both the US and the Australian market. And in fact, if you look at the amount of money that's index aware, so that means actually following the index or following most of the index with one or two exceptions, it really now is the single biggest driver of capital flows in both the Australian, US and European markets. And you see that by when you look at the number of mandates being appointed as well as the estimates of total amounts of capital.
So, Mark, you've written a really interesting piece on this, saying that we can see some distortion or it can be less efficient. Just explain for us.
Yeah, I based the piece on a study that came out called Passive Investing and the Rise of Megafirms. And the authors of the study looked at data in the US between 1996 and 2020. And basically what they did is they measured or attempted to measure the impact of the shift into passive investing. And so there were lots of different results, but one of the things they found is that the 50 largest shares in the US, they outperformed by 29% over what they would have if it wasn't for these passive flows. And they also found that simply an investor reallocating from active into passive would actually push the market higher because, of course, passive investing, those large capitalization stocks get more of every dollar invested, where active investors obviously are trying to find where they perceive value throughout the market. So it does show that there were certainly impacts from this big shift towards passive investing.
And what does it mean, Andrew, as well, for volatility?
Well, in theory, passive investing, once it reaches a certain point, will break the market. Jack Bogle said in 2017 that and Jack Bogle being the founder of Vanguard, the world's first and largest passive investment company, said that if everybody indexed, the only word you could use is chaos and catastrophe, but it's not going to happen. And that's really borne out if you think of it quite logically. If no one's out there doing price discovery, everyone is investing based purely on size of market cap, then you're going to get more and more surprises because no one's digging under the hood to find out what's going to happen before the surprise occurs. This chart that we've got up here shows, for example, the intraday volatility around reporting season for most of the last reporting periods. It actually doesn't have the most recent one, which is highest still, but was the 3, 6, 8 reporting periods prior. And what that chart is really showing is it's showing that as we are moving more and more towards a passive investing dominated market, so too is intraday volatility increasing materially, in fact by about 40% since February 22 around reporting season, which ties in with that sort of theoretical idea. If no one's out there trying to predict, or a very small amount of people are out there trying to predict, is this company going to have a good or bad year? Well, then the first we know about it is the result, and that creates a very large movement where, of course, the efficient markets hypothesis states or implies that all of that information would have been gathered before the day of the announcement, and there should be no surprise at all. So you can sort of compare them as the two alternatives. In a market driven entirely by active investing done well, big caveat, done well, there should never be a surprise around an earnings announcement. And in a market driven entirely by passive investing, there would always be surprises. So the question sort of is where do we sit between that, and what can we do about it? You know, Mark, mentioning your paper, but there was another interesting paper last year by Salmon et al. In the Journal of Management Science, and I'll give you a quote. It said that passive ownership negatively affects the degree to which stock prices anticipate earnings announcements, and the rise in passive ownership over the last 30 years has caused the amount of information incorporated into prices ahead of earnings announcements to decline by approximately 25% of its whole sample mean. In other words, our ability to predict rationally what should be occurring has been materially impaired as just less people are looking.
And to your point there where you say people maybe not looking under the hood, Mark, what does this mean then? Is there less incentive sometimes for investors to maybe do their own fundamental research?
Yeah, I mean, I think there's different ways of looking at it. I think some of the passive critics look back at the pre-passive time as this investing utopia where these very smart investors were rationally assessing companies and making the right decisions. And, you know, that wasn't true. And I think that, you know, the market is obviously complicated. There are investors with all types of different goals and motivations. Some people are day trading. Some people are long-term fundamental investors. And so you get this mix-up of all of these different things people are trying to accomplish. And I think, you know, when we say passive investing, if we go back to Bogle, which we've obviously been talking about, you know, his view of passive investing is the thing that was passive was you. That you weren't making any decisions. People are using passive products and they're trading them. And so I think to say that passive investors are not fundamentally driven or not driven by fear and greed and all the emotions just isn't true. People are using these products to do lots of different things with them. So yes, I think that it does change the market dynamics, but I think as a long-term investor, the fundamentals still matter. So, you know, that study that I cited that said the top 50 shares had gone up 29% more than they should have over that very long time period. Well, the market went up 850% during that time period. So it influences markets, in my view, but it is not the sole driver. And I do think that over the long term, it still is fundamentals.
What about the concern, though, either of you, that passive investors can then sell everything in a downturn and you could see a crash?
Yeah, look, I don't think that part will happen, but I think what really is interesting, and Mark sort of touched on it, so I just want to draw it out. There's two different ways of looking at this problem as to whether it's good or bad. The first is from the investor's perspective. Is this good or bad? You know, is this going to enhance my returns? And I would say that the rise of passive investing has been wonderful for returns, both for passive investors and for active investors. For passive investors, because it's given them a product that they can sleep easy at night that will achieve a meaningful return, not wonderful, but good enough. And for active investors, it's given us that beautiful example of playing poker at a table with a group of patsies. You know, if you know that the vast majority in the market is investing, buying or selling based on things other than the fundamentals, your edge by understanding those fundamentals has just materially increased. So from that point of view, passive investing has been wonderful for value investors. What it hasn't been wonderful for is the purpose of the market as a capital allocator. Because in theory, the market should be allocating capital to the very best ideas and the very best management teams and acting as an engine of creative destruction to drive economic growth. If it's not, and the vast majority of money is going simply to the biggest things, as opposed to the best ideas with the best management teams, or going there because of themes rather than fundamentals, then you will see, and we are seeing, a material decline in both the efficiency of the market, okay, tick academic box, who cares, but more importantly, a material decline in economic productivity. And I think that, to a large extent, is perhaps responsible for part of the economic malaise that we found ourselves in for the last 20 years.
What about some of the benefits, Mark, though, that might outweigh risks, potentially lower fees, some strong outcomes here too?
Yeah, I mean, I think the important thing to remember is, you know, the rise of passive investing hasn't happened in a vacuum. You know, most active managers are underperforming. So I think, as much as we want to sit there and paint passive investors as just people plowing money into the market and pulling it out, and they're unsophisticated, and there's all these ways we characterize passive investors, but ultimately I think they're making a rational decision. Why should I pay higher fees to a manager that is unlikely to beat the market? So I think overall it has been a benefit for investors. I agree with some of the points about capital allocation and kind of this feedback loop where large companies are getting more funding, so of course they're doing better, and like all of that I think is true. But I think just from an investor standpoint and me trying to grow my super, I do think it's a positive thing.
And if there is a little bit of distortion, does that create opportunity for value investors potentially elsewhere?
I mean, there's always been distortion, but yes, I do think it creates an opportunity. And an example, and this is personal, this is my personal investing, not Morningstar, but I'm an income investor. And so when I sit there and say, okay, if there are distortions, if we're going to start to look at mid caps and small caps, there's potential distortions, and maybe that's an opportunity where I can get a higher yield and more dividend growth than potentially I could have before. So if I am focused more on income and not necessarily passive flows driving large companies, then maybe that's an opportunity for me to distort that.
What do you think about that?
Yeah, well, I said before, I think we need to separate the winners and losers at a personal level, the investor level, from the economy. The economy loses by this, but individual investors often win. The person who used to get taken advantage of by a shonky broker now has an opportunity to just own a passive fund, achieve the market return, and be safe. That's not good for business, but you would say it's only fair for Mr. and Mrs. Jones, who otherwise were, being hurt by some unproductive parts of the market. I think the challenge, though, is that anything where money is moving based on rules opens itself up for targeting by unethical actors. So what do I mean by that? I mean that if there is a bunch of herd doing one thing, it's very easy for the dishonest person to try and take advantage of that, to game the system, in other words. And I think that to some extent, the risk with passive investing, other than the return being good but not great, and you can argue whether that's good enough, that's a personal choice, it depends where you sit in that spectrum, right? But the biggest risk by far is the ability for the market to start becoming co-opted by more and more sharks who take advantage of the knowledge that less and less people are looking. It's much, much easier to commit a scam when no one is asking questions, and it's much easier to manipulate the market when the market doesn't have the participants asking questions. Are we at that point yet? I have no idea. Potentially Shield and First Guardian are examples of that. Certainly I think there are some other big accounting scandals at the moment that are examples of that. Is that at a point, though, that it's any worse than any other period in history? I don't know. People have been bad actors since time immemorial, right?
Yeah, absolutely. The other point, though, and you mentioned herd mentality there, do you think, Mark, that means that some of the bigger companies could be disproportionately affected or benefited, I guess, because passive flows tend to go to some of these bigger companies?
Yeah, I mean, I think on either side, right? And I think a lot of the critics around passive investing are worried about this mega bear market that happens. Now, part of this is they've happened in the past. If we look at an 80% drawdown in the 1929 crash, we look at what happened during the GFC, the market has shown it can fall significantly without passive investing. But I think that's the fear, and right? So if these firms benefited when there was a run-up in the market, then if there's money coming out, they of course will disproportionately be hit. I think that ultimately, I guess through a market cycle, that's just the new normal and something we need to get used to. It's not something that necessarily keeps me awake at night. I never thought there wouldn't be bear markets. I think there will be bear markets going forward. So yeah, it's not something I'm that worried about, but yes, it should have an effect on the way down as well.
I guess, final question, both of you, would we be better off without passive investing?
Completely without passive investing? No, I think there's a place for it. I think there's 2 points to it, though. There's where do you sit in the spectrum of using it as a product? So, there's that lovely quote, and I know, Mark, you've said it before, it's sort of the classic one, 80% of active investors fail to beat the market after fees. Well, of course, 100% of passive funds fail to beat the market after fees as well, because they're holding the market, and as long as they charge a single basis point of fees, they have underperformed it. So it's a little bit of a false dichotomy. But having said that, like the Dunning-Kruger effect in Swedish car drivers, where 85% of them said they were better than average. Don't ask an active manager if they're better than average. The answer is always yes, and that cannot be true. So if you're an investor who either is not confident that you're better than average, or perhaps their returns, even if your confidence is high, don't say you're better than average, then a passive product is a much better approach than continuing to get a worse return. Having said that, there are certainly risks you have to be aware of, both as the investor using the product and as regulators and the market. And I don't think as a society we have yet confronted those. And the four key ones for me would be, we will expect, as passive investing rises, to have greater and greater volatility in the market. That's starting to happen, I think. Now, maybe that's not as high volatility as 1929, but in the long run, you should have, on average, higher volatility. Secondly, you can expect that bubbles will get larger and continue longer, and crashes would, in theory, in the converse, be deeper and continue longer. Thirdly, as I mentioned before, I think you could find more scams and smoke and mirrors in the market. And then lastly, and perhaps most confrontingly from just a personal political point of view, we should see rising wealth inequality, because the differential between the haves and have-nots, when there isn't price discovery, accelerates based on your initial starting position. It's just basic mathematics that'll do that. Now, that's not necessarily a problem for any individual investor, that's more a problem for society as a whole, but it certainly feeds into that narrative.
And I guess this is just asking you to sum up your article in like 30 seconds.
Yeah, I mean, I think overall passive investing there's been a lot of benefits, namely lower fees, even for active products. My worry is investor behavior. People think they're investing passively. They're not. They are going risk on, risk off all the time using these passive products. So my worry is that all of those things that really hurt individual investor returns, they're exasperated by passive. And so that concerns me a little bit.
Great to chat, gentlemen. Really interesting stuff. Andrew Coleman from Team Invest, Mark Lamonica from Morningstar. And next up, we go head to head. Well, if markets are increasingly driven by flows rather than fundamentals, investing becomes a very different game. So how should investors respond? Well, in this segment, we look at whether these structural shifts are creating risk or opportunity, and how value investors can position themselves in a market that may not always be thinking clearly. Joining me and Andrew on the desk is Angus Geddes, CEO of Fat Profits. Great to see you, Angus.
Good to be here.
So what type of investor are you? And tell us a bit more about Fat Profits.
So we are Contrarian-based investors. We take a fundamental approach to sectors, stocks, markets that are pretty much out of favour. And we also use technical analysis to try and get a good sense of timing in terms of entry points and exit points. So Fat Profits has been going for 25 years. We started out as an independent research house, and we now also run a funds management business, and we have a listed hedge fund on the ASX, and we very much cater to retail investors, mums and dads, but also high net worth individuals.
And if markets are increasingly being driven by passive flows and algos, how do investors adapt?
Well, I think you've got to be a little bit careful about algos and passive investing, because sometimes trades can become quite crowded. And of course that sets the market up for a move in the opposite direction. So, we very much sort of look for uncrowded areas of the market, and, some of the themes that have been a little bit more overlooked. So you won't find us sort of chasing the hottest thing in town. We tend to be sort of leaning in the other direction. But having said that, exchange traded funds, passive investing have a place. For example, we're thinking that uranium stocks are a good place to be looking, as is the gold sector at the moment. Nothing wrong with an exchange traded fund which can actually diversify a lot of that specific stock risk away.
Andrew, your take on algorithmic trading?
I mean, it's just supply and demand, right? I think what we're talking about here is flows of money, as opposed to anything affecting how a long-term value investor would approach anything. I mean, the reality is still a wonderful business with strong moats and a good management team that's growing well, bought at a reasonable price, is a wonderful investment, and missing any of those criteria, either not a wonderful business or not a wonderful price, is likely to end up a poor investment unless you happen to get very lucky and time it perfectly to get in and out, and I would say that's more luck than skill. I think where it comes down to with algorithms and flows of passive money is just simply that the weight of capital can really overtake one side of the equation of the ledger. In other words, you can get a huge amount more money in the buy column than you should based on theoretical fundamentals, or way more money in the sell column. And so rather than the market acting as a really good weighing mechanism, accurately valuing assets, it can overshoot materially and overshoot more than even human nature would sometimes overshoot it. Now, for a long-term investor, that's wonderful because you don't have to buy when it overshoots high, you can sell, and you don't have to sell, you can buy when it overshoots under. On the other hand, if you're someone who either needs to move money really regularly, you're someone who has to go in and out of the market all the time, or you're someone who has to buy high, sell low because of your funds management mandate. Now, neither of us would be, but there are others out there that have to do that. Momentum strategies, for example. That's a really dangerous time because it means that the swing may well be larger than you expect and faster than you expect, which of course to us doesn't matter, but to a lot of people does.
Angus, we're talking about how volatile markets are at the moment. It's been an extraordinary start to 2026. When you look at share prices in general, are they less reflective in your view of what we're seeing in underlying businesses in terms of value than they potentially used to be?
Look, they can overshoot. 4 weeks ago, before the advent of the Middle East war, the market was pretty buoyant. We saw pretty high valuations in the US. So they can overshoot on the top side. And then, of course, sentiment can change quite quickly. We've had the outbreak of the war. Sentiment skewed the other way. So I'd probably argue, value's almost sort of overshooting at the moment. Sentiment's sort of overplaying its hand.
What about you, Andrew? Do you think there's still opportunity for value investing?
Oh, huge amounts. But I don't think that's any different.
Yeah.
Maybe there's a few more now, but in general, there's always opportunity. There's always an advantage in being rational when everyone else is irrational, in general. I was actually thinking about this earlier, getting ready for the program, but I was on one of the monthly wrap-ups with you back in January, and you asked me what I thought my theme for 2026 would be. And I said I thought there'd be a snapping back of PEs, that we had a very bifurcated market. We had lots of companies at the big end of town trading on multiples that just their actual earnings didn't justify. And at the bottom end of town, a lot of companies trading on PE ratios that looked stupidly low. And I think all we've seen with the Iran crisis is people waking up one morning and going, why am I paying that? And then, geez, that one looks cheap. And they both flipped back to the middle. Now, in theory, we should have a market whose PE ratios are distributed like a Gaussian or bell curve. Most people around the mean around 20 times, a few extremes high and low reflective of the companies. We didn't have that in January. We had an inverse bell curve, a parabola, lots on really high multiples, lots on really low multiples. And all we've seen in the last few months is that crowding back towards the middle.
And you talk there as well about signs of an index effect. So companies sort of trading at a premium simply for being in the index. How do you kind of approach that?
Yeah, well, look, in theory, it shouldn't happen, right? I mean, in theory, being in or out of an index should have no impact whatsoever on the value of the asset. That's like just saying your home has more or less value because someone else includes it in a bucket they're measuring. That makes no rational sense. However, we have started to observe in academic literature the beginnings of this index effect occurring. And in fact, we find it in two things. Number one, Duffy did a paper, Duffy et al. In 2025, which actually showed that from an actual point of view in the US market, inclusion in an ETF creates a share price premium compared to the stock trading outside the ETF itself. In other words, if there are two stocks available in the market that are identical, the same company, you can buy it outside the index or in the index, inside the index, you pay more for buying the ETF holding the index than holding the stock itself. That's irrational. It can't be sustained forever. Potentially that's some of what we're seeing is the fall in some of the big end of town. And the other thing is I did some analysis back in October 2025, which I think there's a graph you may want to show, which showed that index premium in action for the ASX. And effectively it showed a 40% premium for being inside the 100, a 26% premium for being inside the 200, a 23% premium for being inside the 300 compared to the rest of the market excluding that. That is not sustainable. That means investors crowding in and paying more for every dollar of earnings simply because it's in a bucket I can measure than in reality that company deserves when it's out of that bucket. And it's no surprise that where have the biggest falls been in the market in the last few months when people, I think, have woken up and started acting a bit more rationally again? Well, in the companies with the biggest index premiums.
Angus, in your view, what does that mean for markets and whether or not it makes them harder to outperform here too?
Well, I think, as a contrarian investor, I think it actually makes it a bit easier for us because, by definition, you're looking for sort of uncrowded trades, uncrowded companies, stocks that are very much sort of outside perhaps the magnifying glass of a lot of fund managers. Take for example CSL. It missed on earnings. It was quite crowded about a year ago. There were a lot of fund managers who thought it was cheap and that there was a value play to be had in that company. And then what we saw, of course, after they disappointed the market, the stock got dumped. And I guess this is where we sort of come into it. I think when you do get those sort of crowded trades and the market starts unloading on it, that's when something gets really interesting because, often a share price or a company will bottom out on bad news. And typically what we try to do is buy them when they're as under-owned by the broader market as possible. And by definition, that really means you want these types of companies to have a really small weighting in the benchmark, as we've seen with CSL, for example. I'm not saying we're buying CSL today, but you know what? You want sort of almost underrepresentation relative to the index. And then basically look for those sort of upside surprises. So it's when something's gone down that really attracts me. Something's been going down for a while. It starts bottoming out on bad news. It becomes really under-owned by the broader market, certainly the professional end of town. And then you'll get an upside surprise, which comes as a surprise catalyst. And all of a sudden, the stock's sort of back in the race. So, we continue to wait for that to happen for CSL. But those are the types of situations that we look for, rather than buying the hottest thing, on the street, which is over-owned by definition, big chunk of the index. It's only going to go one way if there's any disappointment.
So to that point, Andrew, some of the best opportunities can be outside the index.
Yeah, I mean, absolutely. I don't think being in or outside an index makes any difference to whether the opportunity is good or bad, right? I think that the challenge we get caught up with as humans time and time again is we're herd creatures by good evolutionary reasons. It didn't make sense running away from the lion to run all in different directions. That just meant you all got eaten, right? So from that point of view, there's a big incentive for humans to want to be liked and want to crowd in together on the up and the down. But, that's a very silly investing strategy. It would be the equivalent of only going into a store when it's not on special. Saying, oh no, they're on sale today, I can't buy, I've got to wait for them to put the price back up. And yet that's what indexes do, right? They buy high, market caps rise, so they become a bigger proportion of the index, so more people throw their money in, and then they fall a bit, they go on special, and everyone goes, oh no, sell while it's low. So they become self-reinforcing as a very quick way of losing money. And Team Invest, there's that lovely saying from the Odyssey, in the land of the blind, the one-eyed is king. And as a value investor, a team investor or a Buffett-style investor, the more people are blind, the easier it is for you to make money even if you're only one-eyed. So let alone if you know the company brilliantly, really inside your circle of competence, it becomes easier and easier just to make money because people are running around like lemmings. What the hell's going on? I'm an ex-cricketer. Not necessarily a very good one, but my idol, of course, as most young Australian boys, batsmen growing up, was Donald Bradman, and he famously got asked, how did he average so much? And he said, you can't get out caught if you keep the ball on the ground. And it's the same thing as an investor. You can't get out caught losing big amounts of money if you keep the ball on the ground, if you buy wonderful companies without debt, with good management at low prices. Yes, there are periods you won't perform because other things will be more exciting and the flavour of the month. But in the long run, compounding and the power of that investment will far outweigh any FOMO in the short run.
Angus, you touched on CSL and the big move that we saw following a disappointing result, and that's sort of been very prevalent in the most recent February but also August reporting season with a number of some of these big companies that missed. Is that a sign the market's doing less fundamental work, do you think?
Probably baking in too much optimism. And I think, when we've been talking about crowded trades, when there's too many people on a company or a theme or a thematic, and they're all looking for a similar outcome, by definition, that sets, the market up for a nasty surprise. And you're right, we have seen quite a lot of dispersion in relation to that. But what I've sort of found is that the less people are looking at something, and it might be sort of, a company might be going through a hard time, or a market might be really out of favour. Doesn't really take much to turn it around. And it was interesting just hearing your analogy before, because I sort of liken it to ice skaters out on a rink. Mm-hmm. When the sun's out and everybody's out on the ice, does that necessarily make the ice safer or more dangerous? In the markets, it tends to be, people tend to think it's safer, but it's not. When there's one or two people out skating around on the ice, people think it's a safer environment. So, and I guess this sort of goes back to what we're saying about passive investing. Sometimes the uncrowded path, the uncrowded stock, the uncrowded market is often, a safer proposition at the end of the day.
So in your view, what's one practical change that investors could make to really, see movement driven by flows rather than fundamentals?
Well, I think, looking, if you sort of wake up and read the business press, the newspaper, and, everyone's in the market is talking about a particular sector, let's say lithium, it's signed to sort of head for the hills. I'd be on the lookout for really, really popular bulletproof type themes. I mean, it was only at the beginning of the year that, software stocks never went down. And, how the world's changed, in the last sort of 4 to 8 weeks. I actually think software's getting quite interesting now. So whatever's really topical, whatever's really in vogue, I would be counselling to look the other way and take a path that's less trodden.
What's one practical thought in your view, apart from watching Wealthy and Wise, Andrew?
Apart from watching Ausbiz and Wealthy and Wise. Look, being rational doesn't make you popular, it just makes you rich. So the question you have to decide if you're going to be an investor or playing in this game is, do you want to be popular or wealthy? If you want to be popular, read the AFR, do everything the AFR says, go into all the crowded trades, you'll be the life of the party and everyone will ask for your opinion. But you won't get good returns. In order to get good returns, keep your eyes open and stick to the basics. Keep the ball on the ground, as Bradman would have said. Buy good businesses that are profitable, that aren't loaded up with debt, that are run by people who are capable, ethical, and have skin in the game, and just pay a reasonable PE for them. We did an episode a couple of weeks ago about the fact that what is the most loved sector in the market one year is almost always the least loved the next. And I made the joke, the viewer question was, how do you feel when you've missed out on one of these trends? And my response was, wait 18 months. Because that's roughly how long these trends go. The thing that was up now, 18 months later, will be down, and the one that was down will be up. So if you buy good assets and then you're just, I was going to say patient, maybe the answer is lazy. You stay in them and you don't overthink it, the natural compounding effect of owning a good business at a reasonable price will make you very, very wealthy. If you want to dance in and out and try and pick the trends, you'll be popular, but you won't have money.
You're watching Wealthy and Wise on Ausbiz. Stay with us for You Asked. Well, now it's time for You Asked. If you do have a question, email us at wealthy@ausbiz.com.au. This week's question is from Nathan. He asks, what stocks have you been adding to, considering the war in the Middle East and the impact it's already had on markets? Angus?
Well, I don't think you can go past BHP and Rio. They both had 20% pullbacks from recent record highs. Iron ore hasn't collapsed in a heap yet, and copper prices are still holding up. And I think if you believe in the world going to need a lot of materials, a lot of base metals, to basically rewire the world for AI and all the data centers that they've got to build, you can't really go past those two big companies at the moment. Look, I also like the gold sector. Obviously, it's had a huge fall in the last couple of weeks. It seems to me like there's been a lot of sort of deleveraging going on. It was very popular. A lot of ETFs had piled into that sector. So, there's been a lot of indiscriminate sort of selling. And, like if we do get a bit of inflation, that's probably going to benefit the gold price. You're buying some of these high quality gold stocks in Australia for 30% cheaper than 3 or 4 weeks ago.
What about you, Andrew?
Yeah, I think if you're a long-term value investor, the joke is what's new, right? When I was born, there was a war in the Middle East. When I was 10, there was a war in the Middle East. When I was 20, there was a war in the Middle East. There's still a war in the Middle East, right? It just goes in cycles, in and out. So from that point of view, if you're a long-term investor, nothing has really changed. Businesses that are stable and well-run and not exposed to major moves remain well-run and not exposed to major moves, and those who are exposed to major moves or were frothy are getting hurt. That's what happens. So as a result, though, there are some wonderful bargains because the market doesn't move rationally like that. The market sells everything, buys everything, jumps in and out, a bit like a bipolar business partner, as Benjamin Graham would have put it. And so, companies that are completely unaffected by what's going on continue to grow very strongly and are available at what looks like a very cheap PE right now, include companies such as Jumbo Interactive, which of course is a lottery software company here, ResMed, medical device company, REA Group. I mean, we're still buying and selling homes at the same frequency, regardless of whether a drone hits a building in the Middle East or not. Objective Corp, government is still doing data management the same way it was before. NIB Holdings, healthcare insurers haven't changed. CSL, we mentioned before, our need for blood plasma, renal and vaccines is unaffected by the price of oil. And then lastly, Smart Group, salary packaging and the administration of that is unaffected. Now, those are just a handful of examples, but they're all companies that meet those same criteria, growing strongly, high return on equity, little or no debt, strong, capable, ethical management that were market darlings not that long ago that are now trading on materially lower PEs. And so if you liked them when they were expensive, you should be very excited that they're on special.
Fabulous insights. Thank you so much, gentlemen. Andrew Coleman from Team Invest, Angus Geddes from Fat Profits. Thanks for watching Wealthy and Wise. We'll see you next week.
Wealthy and Wise is your guide to value investing, powered by Team Invest.